This is going to be a mini lecture for Chapter 10. We have two chapters that cover payroll. Chapter 10 covers the employee side. So we're going to do calculations, and we will have two journal transactions to record payroll from the employee side. And Chapter 11 we'll look at payroll from the company side, employer's side, because the company also has to pay certain payroll taxes and do calculations that are invisible to the employees but still have to be done. Okay, so Chapter 10. So first of all, everything we're talking about in this chapter just relates to employees. It does not relate to independent contractors. So we're going to abbreviate employees EE. And the main thing here, how to distinguish between employees and independent contractors, is this word, control. If the company has control over the employee, the company can tell employee how to work, what to do, what uniform to wear, what tools to use. If there is a direct supervision, control, then that the employer has, ER is employer, then we have an employee. Independent contractors are different. They decide how they're going to do their job. They offer their services to multiple organizations that sometimes compete with each other. There's no direct supervision. So whatever we're talking about in this chapter does not apply to independent contractors. So here are examples of employees. The company president, the bookkeeper, the sales clerk, the warehouse worker. These are all employees. I think there is one homework problem where you are asked, you have employees and independent contractors, so you just ignore independent contractors. You do not include them in calculations. Okay, explain the major federal laws that relate to employees' earnings and deductions, or withholdings. This is the major law. It's called FLSA, the Fair Labor Standards Act. And guys, your textbook is somewhat confusing here. There are 4 provisions. This law regulates, it doesn't cover every company. Usually it covers companies with 20 or more employees, and companies that are engaged in so-called interstate commerce. So it doesn't cover very small companies or mom and pop shops. But it has 4 provisions. So it regulates the federal minimum wage, which is only $7.25. Now, in California, as well as in many other states and municipalities, some cities, we go above and beyond the federal minimum wage. So, for example, for 2020, the minimum wage for California is $13 per hour for all companies that have 26 or more employees. But the federal minimum wage is regulated by this law and is currently at $7.25. The second provision is child labor. Child labor is, of course, legal in the United States, but we regulate the hours during the school year. Not we. This law limits the number of hours children can work during summer versus during school year. It also restricts children from working with chemicals, alcohol, and so on and so forth. The third provision is that this law sets the overtime pay. In general, we will assume in this class, whatever is above 40 hours per week, we have to pay employees 1.5 of their regular pay rate. But now, not everybody is covered by this provision. So excuse me. So the law distinguishes between exempt and non-exempt employees. Non-exempt employees do get overtime. They are not exempt from this law, from 1.5 overtime provision. Non-exempt employees, such as sales clerks, bookkeepers, any kind of administrative assistants, purchasing agents, they are non-exempt. They do get overtime. Exempt employees, I am an exempt employee, so professors, teachers, doctors, professional accountants, accountants with bachelor's degree, they are excluded, exempt from this law. and they do not get overtime. So these are 4 provisions of FLSA. The next federal law is called FICA, F-I-C-A, FICA. FICA, the Federal Insurance Contribution Act, established 2 taxes that all companies and most of the employees have to pay. It's the Social Security tax, here's a description, and it's the Medicare tax. And we will talk about these 2 taxes in detail later in the chapter. So this is a great table. I put it together for you. These are federal payroll taxes. Well, payroll taxes. So this is FICA Social Security, FICA Medicare, federal income tax, FUTA and SUTA, which is federal unemployment tax and state unemployment tax. We will talk more about FUTA, SUTA more in chapter 11. State and local taxes, and then voluntary deductions, not required by law. You can look at your paycheck if you're working, or if you ever worked, and you can find this middle column. This is what you will see on your, as far as deductions go, you will see on your paycheck. So middle column is what do employees pay, and we cover it in chapter 10. And the third column is what employers pay, and we will cover it in chapter 11. So this will be covered mostly in chapter 11. So don't memorize this, but look at them. Social Security is split between employees and employers, 6.2%. So if you're an independent contractor, you're paying both of this. You're paying 12.4%. And also, guys, this is important. People who make a lot of money do not pay Social Security on any earnings above so-called cap, Social Security cap. So your textbook uses this cap. So if you make $122,700 per year, one person, one employee, or less, everything is taxed. If you make money above this cap, above this amount, whatever you make above this amount is not taxed. You do not pay Social Security. So it benefits really wealthy. In reality, if I go online here, the Social Security base or cap right now in 2020, this is the amount, $137,700. You can see it increases every year, but we're using an older edition, so this is what we're going to use, $127,200. Let me go back, I'm sorry, $122,700. This is the base Social Security cap we will be using. So whoever makes above this amount, that excess is not taxed for Social Security. Medicare is also split between the employee and employer. So employer matches our Medicare and Social Security. We pay 1.45% on all earnings. There is no cap, no limit, and the company matches it. FIT, which is the federal income tax, there's no one percentage. It depends on 3 factors. It depends on the number of allowances, which we claim on W-4. Our marital status. In general, married people pay lower FIT than single people, and on the amount of money we make. The more you make, the more you pay. The company does not pay FIT for us. We pay it ourselves. FUTA, SUTA, we do not pay it. The company pays unemployment. FUTA is a very small percentage, less than 1%, 0.6%. And guys, there is cap. There is a cap, $7,000. So when the employee makes up to $7,000, the company pays this tax per year. As soon as the employee reaches the cap, whatever he or she makes above the cap is not taxed for FUTA or SUTA. SUTA rates depend on the company, it has to be given. It depends on the economic situation, on the company, on the state. So the rate has to be given. There are some state and local taxes, like state income tax we pay, short-term disability insurance we pay. We will not go into detail here. And of course, there are voluntary contributions that employees make and companies make. So there's also workers' compensation insurance, and most states require companies to buy this insurance. So if the employee gets injured on the job, the company has to pay for their medical expenses and sometimes retraining. Okay, How to calculate gross earnings for employees. People could be paid, employees could be paid hourly or salary per month, or per 2 weeks, per year. Commission basis, which is usually a mixture of salary base plus commission, and per piece. You get paid per unit produced, per student. So I teach at Berkeley Extension, and there I don't get paid salary, I get paid piece rate per student. Or in agriculture, you could be paid per box of oranges. Okay, this is very easy. Gross pay, I give you two examples. Martha works for 40 hours. She makes $20 an hour, so her gross pay is $800. Leon, here is the calculation. Overtime. Excuse me. There are two ways of calculating overtime. So one method is called overtime rate. Another one is called overtime premium. So right here, Andrea earns $25 per hour. She worked for 45 hours. She gets 1.5 over 40 hours. So it doesn't matter which method you use, your final amount is the same. Gross pay is the same. Under overtime rate, I take 40 hours at regular rate, and then any hours above 40 multiplied by overtime rate. Overtime rate is your regular rate multiplied by 1.5. Under overtime premium, instead of taking 40 hours, I take all hours, 45 hours she worked at the regular rate, and then I take her overtime hours at a half of the regular rate. This is overtime rate, $39. This is overtime premium. So the premium is $13, which is a half of her regular rate. The answer will be the same. So overtime rate versus overtime premium. How to calculate Social Security tax. So here is Marta, here is Leon, here is Andrea from previous slides. You just take their gross pay multiplied by 6.2%, which is 0.062 in decimals, and these are the answers. Now, I do want to talk about this Social Security cap again, $122,700 we're going to use. Anything earned in excess, above that cap, that base, is not taxed for Social Security. So let me give you 3 examples here. This is a concept that confuses some students. So just take your time, make sure you understand it. Let's say we have an employee, one employee, she makes $8,000 in December. So now we have to look at her cumulative pay up to this month. So she makes $8,000 in December. So what were her cumulative wages? How much did she make from the beginning of the year up until this month? And I give you 3 scenarios. They're independent. So her cumulative earnings up to December 1st were $85,000. She's making 8 right now. 85 plus 8 equals to 93. She's still below the cap, right? This employee is still below the cap. She has not reached it. So the entire amount, all of her $8,000, this is gross pay, is taxable. So we multiply it by 6.2%. Now, the second different scenario, what if her cumulative were 120? She was below the cap. How much below? $2,700, right? She made 120, so she's still 2,700 below. So even though she makes $8,000 right now this month, only 2,700 of this 8,000 is taxed because it puts her at the cap. 120K plus 2,700 equals to the Social Security cap. So only 2,700 is taxable. Everything else, which would be, what is it? 5,300 is not taxed. She does not pay Social Security on anything earned in excess of base. And the last scenario, what if her cumulative was 124K? By December 1st, she already reached the cap. So whatever she makes right now, she's making $8,000, she's paying no Social Security tax because her earnings are above the cap. So I hope it makes sense. If it does not, rewind it and listen to it again. Look at the examples. Medicare tax. It's easier to think about Medicare because there is no Medicare base or cap. So if you earn 10 million a year, you pay Medicare on all your earnings. So to calculate Medicare tax, we simply take the entire amount of the gross pay, multiply it by 1.45%, and we get the amount of Medicare tax. Sorry. So 1.45% is 0.0145, right? It's less than 1.5%. How to determine federal income tax? We will be using tables. There are tables in your chapter. You will look up this tax. Sometimes it will be given, so be careful. In some of the problems, it's already calculated for you. So the amount of federal income tax that we all pay depends on how much we make, gross pay, depends on pay period. Is it weekly, bi-weekly, semi-monthly? The examples in your book is just for weekly payroll, weekly, every week. Marital status, so you have two tables. You have one table in your textbook for singles and another table for married employees. And number of allowances. These are your dependents, right? So this is a double W-4 form, and we all have to complete this form when we get hired, and that's where we claim the number of allowances. You can count yourself, that's one, or you can go below, you can go 0. So if you go 0, they will take more from you. If you have one dependent, one child, you can claim yourself and that dependent, so you can claim 2. You cannot go higher, but you can go lower. You can claim 1 or 0. You can do 2. So this is an example from your textbook. This is a table. Like, let's say, for example, that, we make 500. Cecilia Wu is married. So we're looking at married person's table. And she has 2 allowances, and she earned $560. So right here, it's called brackets. So we go, you see there is a bracket of if a person makes at least 550 but less than 560. So instead of looking at this bracket, I look at the next one, because it's really 550. Less than 560 would be 559.99 cents. So this is our bracket. She's making 560, so I'm looking at this bracket, and she has 2 allowances. This is the amount of tax. She will be paying $30 right here for federal income tax. Okay, payroll register. This is what you're gonna be doing in most of your homework. So a payroll register is prepared for each pay period. So right now, this is the beginning of the year. It's 1 week beginning January 1st. We have, this is an example from your book. We have 5 employees, and the payroll register, I think of it as a hub of all payroll information. So we include all payroll information. It becomes a part of our HR database. And then based on the payroll register, we will be preparing 2 journal entries. And that's what you will be doing in a lot of your homework. So this will be given to you. You have names, number of allowances, right? This will be given to you. Marital status, pay rate. This is all given to you. How many hours, how many hours employees work. I want you to look at this cumulative. This is, again, we talked about it before. This shows the total earnings for the calendar year before the current pay period. Here it's blank because this is the first payroll period. But starting next payroll period's payroll, you will have cumulative earnings, and we need to know them to watch for the base. There are 2 bases: Social Security tax base, $122,700, and also unemployment, FUTA base, which is $7,000. Okay, taxable wages. So guys, I will go back here for a second. If you look right here, right, nobody earned anything yet, so everything is taxable. So like Social Security, nobody is above the cap, so everything is taxable. Medicare, FICA, nobody made $7,000, so the entire amount is taxable. And then guys, look, Social Security, we take this taxable wage, multiply by 6.2% to get these amounts. Medicare, we take these amounts, which is gross pay, multiply by 1.45% to get these amounts. FICA we do not calculate here. We will calculate it in chapter 11. And then, so Social Security, Medicare, income tax, we look it up, right? This income tax we look up in the tables. Health insurance, this is something voluntary. This information will be given to you. So gross pay, right? So this is like $400, that's gross pay, minus these deductions, 1, 2, 3, 4 deductions, gives us net pay. So we have the deductions, and this is net amount. Net pay is take-home pay. This is the amount of checks we have to issue to each employee. And then, guys, you have the distribution. It's based on the departments. You take gross wages. Like here we have 1 employee who works in the office, Cynthia, and 4 employees who work in the warehouse. So we separate this by department for different reasons. We will need to use this information to calculate costs in managerial accounting. We will be paying different workers' compensation rates. Those who work in the office, we will pay less for workers' comp because there is less chance of being injured, versus those who work in the warehouse. For these guys, we will be paying much higher rate because there is a higher chance of being injured. We use this payroll register. So 2 journal entries, right? This whole chapter results only in 2 journal entries. That's why it's very easy to outsource payroll. Payroll gets confusing. There's a lot of forms, a lot of reporting. So a lot of companies do not process payroll. They outsource it. They hire somebody else to do payroll for them. Then they get information for 2 journal entries to include in your books. So we will have 2 separate entries. We will record payroll expense, and then we will actually pay employees. So usually the date when we process payroll, it could be on the same day, but usually I process payroll, let's say on Thursday, and then I issue checks, paychecks on Friday. Or I process it on Friday, I record, journalize payroll expense, payroll is processed, and then I pay on Monday. So I have 2 separate entries. So don't get scared here. Focus on the journal, right? Focus on the journal. So this is your first journal entry. It's long. It has 2 debits and has 1, 2, 3, 4, 5 credits. Of course, debits must be equal, right? If you add up 2 debits, they will be equal to these 5 credits. Where do the amounts come from? If you look at $480 and $1,767.50. These are payroll expenses. This is the gross pay, right? It comes from this payroll register. If you look, it doesn't show here, but all of these amounts, except for the last one, all like this $80, that's health insurance. This $155. You cannot see it. Let me take this out. Oops. Let me take this whole thing out. But this $155 comes from right here, income tax. And guys, 3259 and 139.35, there are 2 previous columns not shown here. Here they are. 139 goes here, 3259 goes here. Total Medicare. This Medicare tax. These are the amounts we withhold from this gross pay. So they become liabilities. You can see it. They are separate liabilities. It's not my money. The Social Security tax payable, I withhold from the employee's pay. It stays with me. So it's a liability. I will pay this liability to the IRS. So we will do it in chapter 11. I will accumulate this Social Security, Medicare, and FIT, these 3 payables, 3 liabilities, minus plus. And then once a month or once in 2 weeks, it depends on the situation, I will send the check or make an electronic payment to the IRS. So when I make a payment, these liabilities will be debited, decreased, and cash will be decreased, credited. But right now, I'm incurring these liabilities. This health insurance premium payable, I owe money to the health insurance company, right? This $80 is not mine. I have to send a check to them. It's a liability. And guys, I want to show you right here. This is the way I think about it. So look again. This is your journal entry. This is how I think about it. What do you debit? You debit gross pay. This is together gross pay. If you add it together, this is total gross pay. What do I credit? I credit all of these employee withholdings. These are, employee, it's hard to write, deductions, or employee, I will say withholdings, deductions. They're all liabilities. They come from your payroll hub. Payroll register, but you don't have to have payroll register. How did I calculate it? If you add these two together, let me show you a calculator. So 480 plus 1,767 and 50 cents. This is gross pay multiplied by 6.2% gives you Social Security. Oops, something is wrong here. Well, believe me, I'm not going to spend time. Just trust me on this. So if I take these two amounts and multiply by 6.2%, I will get this amount. If I take these two gross pay, again, let me say this is gross pay, right? This is gross pay. And multiply by 1.45%, I will get Medicare. So this is gross pay. These are withholdings. These are employee deductions. And then, guys, the last amount is a plug-in, right? Gross pay minus these withholdings gives you equals to net pay. So this is take-home pay, net pay. And guys, since I do not pay my employees right away, instead of saying cash, I have a liability. I owe this money. This money is owed to my employees. And then, guys, the next journal entry is simply I'm making a payment. The salaries and wages payable. It could happen on the same day, on different dates. I actually pay it off. So I decrease debit the liability and I decrease credit cash. So record payroll, one journal entry, and pay cash to employees, second journal entry. Okay, the last thing here, the payroll register is for all employees. The law requires us to also keep track and maintain so-called an individual earnings record. It's an earnings record that contains information per employee. And we need this information to compute earnings, but also to complete tax reports and in order to prepare W-2s. So next year we have to send a W-2 so that employees could file their taxes, and W-2 is, all earnings, all deductions per employee per year. So here is an example. It's for Alicia Martinez. You can see every payroll period. You can see her total earnings. You can see her Social Security, her Medicare, her net pay. This is just information for one employee, called an earnings record per employee, individual earnings record. This concludes Chapter 10. Thank you so much.